Hello guys, welcome back to my channel. Don't forget to like, share, comment, and subscribe. World stocks slumped for a third straight session in Tuesday as investors worried about continued US and European interest rate hikes after data points to persistent inflation in both regions despite central banks' policy tightening so far. 2 years U.S. Treasuries called a new high not seen since 2007 after data showed U.S. job openings increased in July. This suggested demand for labor was not slowing, but bolstering the case for the Federal Reserve's aggressive monetary policy tightening path to discourage speculation that the Fed might cut rates next year to support economic growth. New York Federal Reserve Bank President John Williams said on Tuesday the central bank likely needed to get its policy rate above 3.5% and was unlikely to cut rates at all next year. Data also showed German inflation rose to its highest in almost 50 years in August, beating a hike set only 3 months earlier and strengthening the case of the European Central Bank to go for a larger hike next month. Reports that Taiwan fired warning shots for the first time at China's drone, which boosted an offshore islet on Thursday, worsened already fragile market sentiment. The S&P 500 index quickly gave up early gains to fall 1.1% to its lowest in over a month. Dow Jones Industrial Average lost 0.69% and the Nasdaq Composite dropped 1.12%. Equity markets continue to be impacted by expectations central banks will keep their foot on the accelerator in terms of rate hikes. Analysts at ANZ Research said in a note to clients. The Pan-European Stocks Index also gave up earlier gains to go down 0.7%, and MSCI's World Equity Index fell 0.74%. The two-year Treasury yield climbed as far as 3.570 and 97%. It hiked since late 2007 and well above benchmark 10-year yields, which rose to 3.153% for the first time since the end of June. Germany's 10-year yield rose to 1.510%, close to the 2-month high reached on Monday of 1.548%. ECB board member Isabel Schnabel had warned on Monday about rising inflation that sent bond yields picking up 12 to 20 basis points. Investors fear that policymakers' battle to contain rising prices worldwide with rate hikes could push economies into recession. One thing is clear, a recession in Europe looks all but inevitable, and the only question is how long and how severe it will be. Frederic de Crozet, an ex-resident of Pitch that Wealth Management Board on Thursday. At the Jackson Hole conference last week, Fed Chair Jerome Powell and ECB Speaker pledged that need for forceful action to tackle inflation, driving selling of bonds and equities as traders jack up near-term interest rate expectations. Investors looking for market salvation from a Fed pivot didn't get it at the Fed's traveling show in Jackson Hole, said Jason Darrow, head of asset allocation for the Americas at UBS Global Wealth Management. Instead, investors should expect the market regime of high volatility and range-bound trading to persist for a while longer. Futures markets have odds of better than two-thirds than the ECB raises rates by 75 basis points in September and see about a 70% chance that the Fed does likewise. U.S. non-farm payrolls data are due on Friday, and markets may not like a strong number if it supports the basis for a continuation of aggressive rate hikes. Okay, that's all for me. Thank you for watching. Don't forget to like, share, comment, and subscribe. See you.